By the way, small sidebar. Somebody in who spoke of that revaluations to 15,000 said it wouldn't be inflationary. It absolutely would, because if gold's going to go to 15,000, silver would move in the private markets, even if it is not by decree remarketed, up to its ratio. You've only really spoiled the geometry of a possible upward spike once you've run this low here. We want to see that low. We've spoken of the 78, 75 range. And we've also spoken of the 65 range.
Gold's relentless rise is sending a loud message. The global monetary system is under growing stress. With inflation proving stubborn, geopolitical tensions rising, and governments piling on debt, gold has surged nearly 20% over the past year. According to Francis Hunt, also known as the market sniper, this isn't just a short-term spike. In his recent analysis, Hunt warns that a revaluation of gold to $15,000 per ounce would not be a controlled or isolated event. Instead, it would ignite a broader commodity boom, driving up the prices of silver, platinum, copper, and more. Such a move, he says, would signal a collapse in the real value of the dollar and usher in severe inflationary pressures worldwide. Hunt also highlights the danger of current investor sentiment. Retail traders and the media are showing excessive optimism, and history suggests that such euphoria often precedes short-term pullbacks. Still, the broader trajectory remains intact. Hunt believes that gold's recent breakout, alongside a falling US dollar index, is a clear indicator of deeper structural problems in the financial system. Gold futures have reached $3,293.30 per ounce, with spot prices not far behind. The weakening dollar only adds fuel to the rally, and it's becoming increasingly clear that confidence in fiat currencies is eroding fast. This is about more than just gold. Hunt encourages investors to watch the entire monetary metals complex, including silver, which he believes could outperform in the next phase. In this video, we break down Hunt's technical perspective and the macroeconomic signals flashing red. If you value profound, data-backed insights into the markets, not hype, make sure to like this video, share it with others, and subscribe to the channel. Thank you for tuning in. Stays alert in these volatile times.
Down here on this structure, everyone was, oh, another dime at $22,000 again for gold, just run it, fall back down again. It was quite out there to be that bullish at that time. And to talk of a 50% move, don't forget, you're at 2,000. You traded 3.5. That's well more than 50%, but our targets at 3 were represented essentially a 50% move. And you got the typical amount of overperformance thanks to the tariff tantrum and the politics and the collapse in the dollar. This last blow off, this little turbo final pop over here, was actually a function of the dollar and everybody suddenly waking up that debt is a problem. Now, we made a call in 2020 September on debt markets, and we've said a lot of things. We said the 40-year bull is over, and that was outrageous. Everybody was buy bonds, wear diamonds. Raoul Powell said it, all the other traders were saying it. You just had a major surge. Bonds had never been more valuable. This was, of course, the stock market crashed, Bitcoin crashed, a whole bunch of things crashed in CV19, as you know, and all that money ran into the fear trade, which was debt markets. And we very shortly after that in September, so that was all March of 2020, said, actually, we've turned. And the pattern structure of that debt market is where we are now in gold. So I am initially going to shock everybody by saying I'm deeply uncomfortable with the way we got rejected on the last run. We thought there was a break. So I'm going to drop the time frame and I'm going to take you into gold because it's quite important everybody listens, because it's going to cause a lot of hate. All our stackers, everybody are going to come out. They're going to want to beat up on me now. I am a long-term investor in precious metals. I am a sound money advocate, but technical analysis is technical analysis. Here's what I've noticed. Luke Groman, lauded in Zero Hedge recently last week, good analyst, by the way, talking about how there's a big substitution of bonds. The best explainer kills it, how the bonds are being sold off for gold. This got a lot of Zero Hedge. Now, by the time my technical trades start to get acknowledged by somebody else, because we are the Cassandras of this market, it's usually a concern for me. This happens countless times. Zero Hedge and other financial media, by the time they're talking it and bragging it. We were saying since the end of 2020, Q3, Q4, September kind of bridges the two, this is a substitution. Now other people running with our messages are now getting lauded. We also had Stanley Druckenmiller saying they short bonds. That didn't say they were buying gold, but I imagine they might be. All of those things. We've had George Gammon, Clive Thompson all come out and say on YouTube that they're going to potentially re-rate to 15,000. George Gammon said to 20,000. All of this. This is only bullish. And this is all debt bearish, what Luke was saying, and gold bullish in the mood. And it's making me deeply uncomfortable. Then we got the technical price behavior that was going on here. When this we thought was a breakout, and we went and we were lauding it and we were laughing and we were also cocksure, etc., and happy days. We were net long here over there on a breakout. And it had fast-paced momentum. It was going all right. The subsequent, here's what happens when you're a technical analyst. When any time something out of the blue happens that is disproportionately unexpected and high momentum, stop and think again. And this rejection, there was something wrong with this. I've got to say, there was something deeply wrong with this. We look at the rejection from the 3.5, that's the rate of decline. We look at our secondary rejection. If this was walking out and squeezing into volatility. The other thing happened on Twitter, everyone's drawing symmetrical triangles and has been following me for a while and is now going gold 4,000. And I'm going too much of retail all in this space. So all the sentiment indicators are making me nervous. I now draw the rejection to the low there. That is a steeper line of rejection. We don't like this. This was a bit of a flag-like grind up, and the hardest pattern to spot was our bond call short. And I'm going to tell you that this technical pattern looks exactly like that. And what tends to happen, because I spoke in the community and I mentioned it once or twice on YouTube, this buying line along the bottom was a bit steep. Typically, we like to see more symmetry. It's kind of flat along the top, but a bit steep along the bottom. So what tends to happen is more and more people have got the script and it says, buy gold on dips. So they're coming up under here, buying gold on dips. Coming up under here, buying gold on the dips. This leads to it being a bit high. Coming up under here, buying gold on the dips. Coming up under here, buying gold on the dips. Eventual breakout, complete fizzle back. It shouldn't have happened. I thought everything was hunky-dory. We're off to the races. 3,800s, 3,750s were a target, etc. Typical upside HVF breakout draw. Then I watch the selling and I go, this isn't right. It is hard. It is strong. And it's violent. Then I think of my reset. We're going into Q3, Q4. It's August coming, September, October. We've got a CBDC launch. We've got everyone bullish and talking about revaluation upside. By the way, small sidebar. Somebody who spoke of that revaluations to 15,000 said it wouldn't be inflationary. It absolutely would, because if gold's going to go to 15,000, silver would move in the private markets, even if it is not by decree remarketed, up to its ratio. You would get a similar move in platinum. Semi-precious metals like copper would have to move. And actually, rather than being a gold-based reset of price, it is an acknowledgement of a dollar-based debasement. That's what would happen. And you would actually start to see softs going up and you would get inflation. It's not a free 3.9 trillion to get. So I disagree with that particular person. So we've got too many people all expecting by decrees we're suddenly going to get a moonshoot. This started excessively to worry me. When I combine it with this price behavior, I'm going to show you our call that we made in the bonds and why I call them similar.
While gold continues to capture mainstream attention, Francis Hunt is urging investors not to overlook the gold-silver ratio, which he believes could still surge to extreme levels. Hunt notes that a spike to 170 remains on the table unless key support zones, particularly between 78 and 65, are convincingly broken. This isn't a forecast etched in stone, but a scenario that the technical backdrop still supports. Historically, such extreme ratios are rare. The last time it reached 100:1 was during the COVID-19 market collapse, a moment that marked a dramatic opportunity for silver bulls. Silver fell to $12 an ounce, only to rebound nearly 150% within months. For Hunt, that episode is more than history, it's a warning. Sharp reversals can and do occur, and assuming linear trends in chaotic environments is a perilous undertaking. In a true demand-destroying crisis, whether triggered by geopolitical chaos or even an unexpected alien distraction. As he jokingly suggests, silver could see a harsher sell-off than gold. That's the nature of volatility, and it's why Hunt keeps emphasizing risk awareness, especially when the market feels one-sided. Let's get back to the interview.
Firstly, on gold. In fact, it's story best told with the journey, where people can see the footprints in the path. So if we're going to go long form on this and just go where we are, because there's a bit of a shock and a twist coming here. So if I pivot you to gold, I will remind everybody that we said this is one of the most important small HVF structures right here in the blue. And many people were sleeping on this particular breakout. They had suffered the indignity of a high at 2021, and they'd seen nothing but downside. The promise of the golden elixir, every time we just ran the 2K, downside. Just ran the 2K, downside. And we said once, twice, three times, fourth time a lady, like the Lionel Richie song. You may remember that. It's kind of a catchy phrase thing we use. And it goes with technical analysis. And we said this is going to turn into a winding up structure. This low leg was at $2,011. That was just after you were sitting on top of the 2,000 support. By the way, you can see the dark blue over here. Maybe I should get my traditionally popular transgender pink out instead. It pops a bit more. And I know you're all rooting for me to do that in Marxism times. Anyway, so when we had this set up, we said, listen, you're probably going to do a 293,000 run from here. Not only will you get the upside of this particular target, which I think was around here, you're going to stay largely going up right the way through, because this is all part of, and then we drew this larger. So we have patterns within patterns. This is how you build wealth, by the way. You multiply your way in there. You use a small pattern to break into a bigger one. And the leg, the flag-like leg, this is a broadening structure. It's not a channel, but the flag-like leg was giving us the 2,900-3,000 vibes. You can see those are the two zones there, 2,900 and 3,000 targets. And everyone was expecting gold-silver ratio downside. Many people would have thought here, that's it, it's the beginning of the downside. Over here, that's it, the beginning of the downside. What we said is people are overpricing or are not pricing at all, or underpricing the possibility that the gold silver ratio could have a spike. And we gave a value of 170 that came technically when we spoke both publicly on our YouTube and others. That doesn't mean it has to happen, but the possibility, we sit here with a probabilities and possibilities curve, and everybody is like, this is just the beginning of the journey down, and all you're going to do is go down, down, down. And everybody is very binary when they face markets. And what you can actually see is that if you continually have crises, you've gone higher after these. And it wasn't the end. You've only really spoiled the geometry of a possible upward spike once you've run this low here. We want to see that low. We've spoken of the 78, 75 range, and we've also spoken of the 65 range. That's when you're in open territory and history. We need to see the gold-silver ratio run these levels to be saying this is the one where we possibly go 30, 15, and just to show that we're not bearish and hate on silver. I'm a massive investor in silver. I think unobtainium can happen. I just think it's been called too many times, cry wolf, and everybody is convinced that this particular one is always the one. And that's what we're warning against. When you have a real demand destroying event, we're all fighting aliens, every country is kumbaya, and now we've got Israel in F-16s, made in 1972, shooting intergalactic aliens down, and whatever amazing show they put up for you, who knows? Everyone will sell. If everyone thinks the world's going to end, they'll sell their metals to go have a final party or whatever the case may be. Who knows what crisis can be created? We've had the World Health Organization pass. Most countries are already all signed up. Yes, great job you did in CV19. Please lock us in so that you can have more powers for the next one you do. That's where you're at in this world, by the way. So more powers. More powers. I mean, arrest people in their homes for non-compliance, for example. That worked so well. The end goal is we're in a debt-based collapse and Marxism across the world, a totalitarian Marxism. Those are my determined, absolute statements that I say that many people have struggled to accept. So who knows? But if everybody then gets into that situation, silver will probably sell off more if we have a demand destroying event than gold. And this can spike. So to put that to bed, I need to see the run of the 65 ideally, and you start to think it's possible when we run that 78. That's our structure there. This is a breakout that's made the first interim target and has had a pullback. It can continue and go higher after that, and that can be on a gold down, silver more down situation. It doesn't mean it has to happen. I'm just saying the current stackers and the YouTube people and the influencers and the mood and the vaults are empty. Everything is like it's impossible, and the only way is there's an imminent melt up. And I get very nervous when everybody is in that camp. It was completely opposite at 2000 when we got to 2000 again and we were looking at that HVF. It was very dopey. Precious metals guys were very fatigued, etc., etc. Now they're hyped and they're excited and they're 1 week away from millionairedom or macro, and that concerns me going into this time period. So I don't know how you feel, if there's anything you want to break down on, but that could lead to another spike. Remember, I've given countless examples, including that, and then it didn't. We all thought every time these were the beginning of the runs, and that's when we flipped. When that one didn't follow through and you had that channel, I said, that's a bull flag. That's another technical pattern that we have. This is a return move. It can go again and go higher. So the possibility exists still. And if we have a bad August, September, October with some drama events, you can get a higher gold-silver ratio.
Francis Hunt's perspective offers a sobering counterbalance to the prevailing narrative that silver's rise against gold is inevitable and unstoppable. Instead of assuming the gold-silver ratio will continue falling, Hunt warns that markets are far more dynamic and far more volatile than most realize. He points to the technical structure that still permits an upside spike in the ratio, even as high as 170, particularly during periods of panic or geopolitical chaos. These are not predictions, but possibilities that informed investors must take into consideration. Historical echoes, such as the 2020 COVID crash when silver plummeted before soaring 150% in months, remind us just how quickly conditions can reverse. Silver may be the metal of opportunity, but Hunt insists it's also the metal of emotional extremes. In actual crisis scenarios, it can sell off harder than gold, misleading investors into abandoning it right before explosive recoveries. That's why his message is one of strategic realism. Silver's long-term fundamentals are intact, but its path may be far more erratic than gold's. This is no time for unquestioning optimism or binary bets. As global debt soars, inflation simmers, and trust in institutions erodes, precious metals remain a critical hedge. Hunt urges stackers to stay alert, stay balanced, and above all, stay flexible, because in chaotic markets, agility beats certainty. If you found this video helpful, don't forget to like the video, subscribe to the channel, and share it with fellow investors who would benefit from this insight. We're committed to bringing you top voices in the financial world, and the strategies you need to navigate what's coming. Thanks for watching.